You're listening to Indications by the Conference Board.
Hello, this is Bart from Erik, Chief Economist at the Conference Board, and welcome to this episode of Indications. Recently, my co-worker Erik Lundh and I had the opportunity to go on a podcast hosted by Double Line Capital's Deputy Chief Investment Officer Jeffrey Sherman and his colleague Samuel Lau. The Double Line Capital LP is an asset manager in fixed income equities, commodities, and multi-asset class strategies. Amid COVID-19, we discussed a host of factors and scenarios relating to both the state and the trajectory of the US economy. Here's a recording of that conversation, and I hope you'll enjoy it.
All right, welcome to the Sherman Show. I'm here today with my co-host, Sam Lau.
Hey.
And today we have some external guests joining us. But before we do that, we want to give you a market update here. Sitting here, day 70 of quarantine. From or work from home, safety at home, whatever the measures we call it. And so we want to get on top of the market. So Sam, why don't you kick us off with what we've seen since last week?
Yeah, sounds good. So the roundup on the market as of close of business May 27th is that the S&P 500 continues to march up from its March 23rd lows. It's up 4% on the week, and that puts it at a negative 5% handle or so on the year-to-date basis. That's just about 10% from its all-time highs. So we'll see if that trend continues. On the bond front, the Barclays U.S. aggregate is up about 40 basis points on the week, putting it up a positive 5% on the year. Gold futures on the front month contract are down 2% for the week, putting it up to 12% on the year. Copper, LME copper is down 2% on the week, minus 15% on the year. And WTI crude oil futures are up 1% this week, but that still makes it on a month to date, again through May 27th, up 74%. But for a year to date, it's still down 46%.
Yeah, Sam, on that note, it's interesting to see that, we've seen this rebound in some risk assets, but commodities have been the one area that really have not benefited at this point of seeing investor demand. So it's just important to note that.
Yeah, and that's right. And I would say that a lot of the commodity price action, at least with energy and the industrial metals, seem to reflect the overall economy a little bit better, I would say. But, that 74% month to date positive performance on CL is also on the back of some pretty weak data price prints that we had coming in through April as well.
So just for everybody's sake, CL is the ticker for WTI crude oil. So Sam's a commodity guy, so just want to make sure everybody understands that.
That's right. So we'll see if all that stuff holds and what some of the divergences are that we see between some of the risk markets here. Moving on to the sovereign front on the 10-year yield part of the curve, treasuries continue to be somewhat range bound, just about 68 basis points through last night. The Bund is still right around 40 basis points, negative, that is, negative 40 basis points. And JGBs, guess what? They're at zero again. In terms of cash spreads on bonds, for the IG market, we have them set right at 175, so in about 20 basis points over previous week. High yield on US are at 650, in about 70 basis points over previous week, and EM also in about 30 basis points to put the cash spread at 425. So you are seeing that grind tighter in spreads and positive price movements across those areas of credit as well.
Yeah, I think on that note too, Sam, one thing to point out too, it seems that the high yield and emerging market bonds have really benefited from the rally in oil prices back to kind of more reasonable levels above the 30 handle in TI, and in Brent trending above 35 these days. And so I think it is important to see that it isn't just a risk on and couple. It's been somewhat decoupled from the equity market rally, but you're starting to see improvement there in some of those names because they are heavily weighted by those sectors of the market, specifically energy.
Absolutely. So moving on to the economic front, starting off as we always do with initial jobless claims. Looks like another, we just got the numbers today, and another 2.1 million filed, bringing the total to now over 40, just shy of 41 million over the last 10 weeks since most states and communities began to shelter at home. On the continuing claims front, the amount of people on that on that data set actually declined by almost 4 million. It's now at 21 million, which is somewhat puzzling. Some people are saying that it's possible that it points to the fact that individuals are getting back on the payroll again. I'm not quite sure I buy that completely. And I think before we get too excited about a drop, like this on a week over week basis, I think it merits a little bit more reflection.
Yeah, and there is some nuance in some of that data that some states, some heavy unemployment states such as Florida report biweekly. So there's some kind of noise in that data set as well. But as we like to talk about, one data point doesn't make a trend, nor does two. You need to see some persistence in that. But it is somewhat uplifting to see that it's only down to, on the unemployment insurance, it's down to 21 million. Bad news is there's another 2 million in the queue for next week. So we'll have to see how that materializes. But at least there is some uplifting news in all this negative data set that we're covering today.
Yeah, and hopefully some of that uplifting news translates over to the actual jobs report with unemployment claims. So we can discuss that a little bit later, I would assume. Moving on to the Fed balance sheet, it now stands over 7 trillion with an additional over 100 billion over prior week. GDP and its components had a sec today, slightly more negative versus the first estimate. So now it's at negative 5.0% on an annualized quarter over quarter basis. Part of that was also reflected within a revision in the personal consumption, which actually did see some signs of improvement there at negative 6.8%, again, on the second estimate on the first quarter U.S. GDP, annualized quarter over quarter. Durable goods came out today, negative 17.2%. This is the second worst print on a month over month basis going back to 1992. It bears mentioning that the worst was in August of 2014 at negative 18.8, but that followed on the backs or the heel of the historical best, the previous month at positive 23%. So I'm sure that
it's funny you mentioned that because there's a lot of literature out there when it comes to equity market returns, and people say, you see these charts that are extremely misleading, I think, where they show, hey, if you omitted the worst 1% of trading days, then here's what the growth of a dollar would look like. But what a lot of people don't realize is that a lot of those significantly negative days are around some of the best performing days as well, because it's a lot of volatility and noise in the market. And so not only do you see that in financial markets as people are trying to digest the future, but also sometimes in economic data series, as you rightfully point out here, Sam.
Yeah, and it goes back to what we've been talking about is, are we in a bear or a bull market with the S&P 500 right now, right? With the fact that we're up about 30% from the lows back in March 23rd that we hit on the S&P 500, which in itself, March 23rd was the low from the previous high, down about, 35% from there. So bull and bear, and it's what Jeffrey Gundlach talks about a lot here with our landscape in California, with Mount Whitney being the highest peak point in California, at least, and right next to the lows in Death Valley as well. So just a little bit of trivia there, I suppose.
Right, so before we move on to more economic data, let's introduce our guests because I'd like to introduce them because I think, the things that we want to talk about are some of their data that they focus on. So joining us today is Bart Van Ark, who's an executive vice president and the global chief economist at the Conference Board. He was appointed back in 2008, and he oversees the production of a widely watched economic indicators and various forecasts. So welcome, Bart.
Hi, Jeff and Sam. How are you?
Excellent. And
Nice
also joining us, because we had the ability to get two guests today. First time I think we've had that on the Sherman Show. We have Erik Lundh as well. He's also he's a senior economist at the Conference Board, and he's responsible for much of the organization's work in U.S. and Chinese economies, and he's based in New York City. So welcome, Erik, as well.
Thanks so much.
Right. So I cut you off, Sam, because I know where you're going, because I have a list of what your economic data prints, because we had to get organized with having four people talking today. So why don't you lead us into the data that just came out today, or the most recent data prints from the Conference Board, and let's lead that into our conversation.
All right. So last week we had the Conference Board print on the leading economic index year over year, down 11.5%. on the tail of a negative 7.3%. And as you know, Jeff, this is one of the granddaddy indicators that we look at to determine if the economy is in a recession. And anytime it drops down to below that zero, it seems to be a pretty good signal that we are currently in a recession. So we'll talk a little bit about that, as we'll also talk about the Conference Board's consumer confidence measures, as well as its subcomponents within that data set. And one thing to note is that the consumer confidence print that just came out earlier this week seems to have slowed or found some footing after a couple back-to-back very sharply negative prints. This current print is at 86.6 versus the previous period's print of 85.7. So some people, pundits out there, are wondering if this heralding this actually as evidence of a potential recovery. So we'll hear their thoughts on that. I'm somewhat skeptical, but then again, I'm skeptical by nature. So with that, I think that'd be a good segue into some discussion points around some of the things that our economist friends here are thinking about.
Yeah, so I think that let's start first off, and let's talk about the LEI and how it relates out there. When you talk about LEI, again, stands for Leading Economic Indicator. Maybe you can tell us a little bit of the work that you guys have done to create that index, and why folks like us rely so heavily on looking at some of these or this aggregate indicator that you guys have created.
So the Conference Board, as you mentioned, produces a variety of indicators for a number of countries that try to gauge economic activity. We have our LEI, which is a leading economic indicator. We have the CEI, which is more of a concurrent one where we're gauging what happens right now in the economy. And then we have a lagging one, which gauges activity looking backwards. LEI is to try to give economists and financial professionals and business executives an idea the economy is trending 6 to 9 months into the future. And we do this by sort of compiling an index that's generated out of 10 to 12 to 13 maybe indicators that have some sort of correlation with future economic performance. And we do this for a bunch of countries. So the data point that you just mentioned for the U.S., we just released last week. This was for the month of April, and what we saw was a very large decline. However, the decline that we saw wasn't as large as the one that we saw in March. The March decline in the LEI was actually the largest decline in that index's 60-year history. So pairing these 2 months together, yes, the LEI is quite negative. Yes, it definitely puts the U.S. into sort of this recessionary territory. The question really is sort of how long and how deep of a contraction are we talking about? And the LEI can give us some hints about that, but it can't really answer the question in and of itself.
So I think Jeff and Sam, what's interesting about LEI this time is that, as Erik said, it had a very sharp dive, actually unprecedented. We've never seen in the history of the LEI such a rapid decline in March and in April. But the other thing that was very interesting is that normally an LEI starts to decline before a recession hits. So when you look at the global recession, or whether you look at the tech bubble in 2001, the LEI would come down before the recession hits, right? So it's providing you a lead. This time, because it was a shock, this pandemic suddenly happened, it just hit right at the moment that we will presumably also begin to date a recession. So that was very, very unique about what we saw this time in the LEI.
And I'm going to follow up with Bart on that. And the reason that it is so unique is because, classically, these kinds of indicators are designed to track, classical business cycles of expansion and recovery and recession. But what we're going through right now is not the result of a classical business cycle kind of movement. We've seen a shock, an exogenous shock to the system, which is COVID-19. So it's hard. It's hard to use these. That's the reason this didn't really point to a recession was on its way, because nobody knew, because it was sort of a tail risk out on the edge.
Yeah, no, definitely. And it seems to be that in general, and we've talked about this numerous times about how typically it's the instability of the system that debt's building, leverage is building. There's a lot of kind of warning signs about the impending recession. However, it typically takes some form of exogenous shock to really set that off. And I think we've seen that here with the case of COVID. But when I look at the, one thing we've always liked to look at is pairing some of your indices together, something like the expectations versus present situation. And expectations for the last year or probably 18, 24 months actually had been very depressed. but the current situation was doing fine, or present situation was doing fine. Then all of a sudden, as you talk about here too, massive collapse in present situation to kind of coincide with where the expectations were, and now we have kind of the opposite effect where now the present situation is dipped significantly below expectations. So how do you guys interpret that today?
Yeah, and that's most clearly visible in the consumer confidence index. So that's actually a really good transition. It's true. Just before we talk about what happened now, it's true that before this crisis hit, expectations was beginning to move sideways. And frankly, that simply had to do with the fact that this had been such a long expansion. Let's not forget we have been in an 11-year-long expansion. We've never seen that before. So everybody kind of felt like, okay, I mean, I can't get a lot better than it is. So these things started to move sideways. Whether you look at the LEI or at the Consumer Confidence Index, they both moved sideways for quite a while. And indeed, we all said, there's always some kind of shock that is then going to occur. Well, that occurred. That was the pandemic. That happened. And what we then saw in the Consumer Confidence Index was just an unprecedented decline in present conditions. So the assessment of consumers of current business conditions and current employment conditions really was huge. Never seen something. It came down by 90 points just in April, and actually in May again it did come down by another couple of points. So it didn't really significantly improve. What happened to expectations, however, is that if the present situation goes down so much, if everybody is so negative about the current situation, it only can get better in many people's minds. So the expectations index, it actually improved a little bit in April, and then it improved further in May. Not dramatically, but just a little. And given the nature of the crisis, it was surprising. But then you need to look at what's underlying that, right? So there are three expectations components that we're talking about: business conditions, employment, and income. Now, all the improvement that we were seeing in expectations in May was due to business conditions. So it had to do with the fact that consumers saw that the economy is beginning to go open up. So you expect that things will be better in a couple of months' time than they are now. When it comes to employment, it's true that there are more consumers who think that there will be more jobs available than less, but it didn't really improve a lot compared to what it was last month. But the big news is on the income side, because on the income side, we actually saw more consumers being negative about income than positive. And that's been quite unique. You really rarely see that negativity is actually outpacing positivity. So that's really an important piece of information, because now that consumers may go out of their home as businesses open up. The question is, once they arrive at the restaurant or at the mall, how much are they really going to spend? I mean, many lost their job, many have seen salary cuts and things like that. So this supply shock is gradually moving into a demand crisis, and that's what the Consumer Confidence Index really is telling us. So I agree with you, Sam, when you said earlier that you are skeptical about how big this improvement is. I think that's true for us too. We don't think this is a great signal that things will get a lot better soon.
Yeah, and I think I was going to say, I think that's absolutely right, because I think as humans, we have this innate desire to want to have optimism. Otherwise, it just makes for a painful life, right? And you point that out that, okay, the business are opening up, so you see that. But then the income component, because income is really earned two ways, is the way I think about it. I think about it's either capital or it's labor. Right. Yeah. So either you have earnings through an income stream via your job, or you have investments. And so we know the unemployment situation. Then when you think about income generating investments, all of a sudden we have a Federal Reserve that's cut rates to the effective lower bound, they call it now, at near zero. And so what you see is that I can empathize with folks out there that are really skeptical about the income prospects for the near term.
Yeah, and again on the market side, I mean, consumers are by far more dependent on wages than they are on the financial markets. So it's really the wage component that is dominating here as far as the income components are concerned.
I was also wondering too, with the income component, if it's people are coming, certain individuals are coming to a realization that, especially the ones who are on the lower side of the pay scale, that we've been hearing the stories about how, given the fiscal stimulus measures at the federal level, this additional $600 a week for $2,400 a month potentially for those who are unemployed, getting that additional piece, that they may be earning more through this the stimulus measure of unemployment than they were when they're actually getting the job. I wonder if it's just a feeling of despair too, realizing that they knew they're probably at the lower end of the pay scale, but now they just see by how much, if they can actually just, get paid more through unemployment insurance than actually going out and working.
Yeah, and it really plays out quite differently, right? So, I mean, people who receive, for example, the government paychecks, the stimulus checks, people who live from paycheck to paycheck, they really spend that money. But a lot of people sort of in the middle income category will actually have put that money aside. If you can just get by, and the nature of this crisis and the risk of possible new waves of corona and everything else, you're going to save this money. And tomorrow we'll get the numbers on savings for April. But in March, the savings in the United States already went up to 13.1%. That was in March. In April, it will go up a lot further. So, you send people money, but they're not necessarily all spending it, except for really the lower end of the pay scale.
Right, which makes sense. I mean, this thing is more regressive when you have these type of impacts. It obviously hits the lower income and the lower wealth folks the hardest. So let's talk about you brought up the idea about an exogenous shock to the system that no one could see coming. I think Nassim Taleb has been out there categorizing this as a black swan. He popularized that idea of the really extreme on the tail risk. Hate him or love him, he seems to be very very divisive when it comes to people's feelings about him. And for those of you interested, he had a pretty nice sparring war with Mr. Asness in the last week on Twitter. So there's some financial entertainment there. But let's talk about the COVID impact here. And so you guys did some research about the impact, and maybe you could lead us through kind of your study and some of the conclusions that you guys have come up with just using the underlying data.
So you're talking about maybe our scenario analysis for the U.S. economy?
Yes, that's correct, on the U.S. economy. I'm sorry, I wasn't clear.
No, that's fine. So, typically the conference board puts out a single forecast for the U.S. economy. We do a lot of forecasts for other countries too, but the U.S. one is one of the ones that I'm most involved in. We usually use the expenditure approach to cutting apart GDP, right? So that's the consumption, investment, government spending, and net exports that you learned about in high school or in college economics. Wrap our head around how this virus was impacting the economy using that model, and we had a really hard time doing it. So what we instead did is we pivoted and we started to generate a new model that actually looks at the amount of value that's being generated by all of the major industries and sectors across the U.S. economy. And so it's easier for us to think about how does this impact travel and tourism as opposed to mining or agriculture. We can kind of set our own stories for each one of these industries and see what falls out in terms of the overall economic growth. So we did this. We built this model. We looked at these underlying industries, and we were able to come up with sort of a sense of maybe what could happen. But there's so much opacity and volatility in what's happening with the virus that we weren't able to commit to a single narrative on this. And so what we did instead is we generated 2 to 3 to 4, depending upon how far back you go, different scenarios in terms of what might happen to the economy at large. And at this point, we have 3 scenarios that we envision for the economy here in the U.S. The first is sort of a U-shaped recovery, wherein there's sort of a gradual opening that occurs over the course of 2020. There's a scenario in which we see a much more rapid opening, in which case the degree of the economic impact isn't as severe as it would be under the gradual sort of scenario. But then if we open up too quickly, we run the risk of letting the virus get a foothold again and basically seeing a second wave and a second set of sort of social distancing policies that fall out of that, which leads to a W kind of growth scenario, which is the worst of all of them. So, at this point, these are the 3 sort of ways that we're looking at this for the U.S. economy. It varies day to day in terms of which one we think has the highest probability. But I think certainly for major businesses, which are the kinds of clients that we mostly are involved with, that U-shaped scenario that has the more gradual opening allows businesses around the country to sort of reduce risk a little bit and to plan how to climb out of this. So we're a little more partial to that U-shaped scenario than we are to any of the other ones.
Yeah, it's really a bit of an alphabet soup, right? I mean, you've got V's and W's and U's and everything, and we go through that as well. And Erik is correct that, the U shape is the one that we think is more likely, although some people now talk about this sort of swoosh scenario using the Nike logo. And, the idea there being that you'll have some quick recovery now in May and in June. I mean, if you close everything down and you open things up, you'll get a pretty good growth rate, right? If you start from nowhere. So you can have May and June recoveries, but then it's going to move sideways because this is really moving, as we discussed earlier, really into more of a demand crisis. But I think there are two things that are really hard in all these scenarios for us. I mean, the first round effects are easy. So those industries that are being impacted by social distancing, as Erik mentioned, like, air travel and restaurants and so on, you can figure out, they've been hard hit. Once they open up, they will slowly come back. But it is the second round effects, which is sort of, if this crisis becomes longer or turns longer and it becomes a sort of normal, quote unquote, recession, then it becomes much more widespread. And then it's much harder to actually map out how that's actually going to impact. The second thing.
And so on that, as
sure.
I think about it, I'm more partial to what you call the swoosh. I try not to advertise for other companies on the podcast, so I call it a square root function. Yeah, that's kind of how I think about it. Because when I think about a U, I think about the coming back on the other side. It gets us back exactly to where they are, and there's symmetry around it. So again, maybe that's too mathematical thinking, but I get the gist of where you guys are coming. And so when you think about that, like, how do you think about the economic and labor recovery functions, what they look like? And, there's already, there was already this polarization of wealth. There was the, purported, or there is a lot of evidence on wage inequality across this last recovery since the great financial crisis. And so, there's anecdotes out there, which you're always going to get with policies, anecdotes where people are making more on unemployment insurance than going back to work. And then there's also this idea that a lot of these people who are unemployed that aren't showing up in the official unemployment data that we saw in the last jobs report are somewhat, they're still employed, but they're just not showing up for work. And so it's a caveat that, it's still thinking that we're going to have a recovery of all those jobs back. So how do you guys start to think about that and model that when you're trying to forecast what this kind of recovery looks like?
Erik?
There was a lot in there, I know, Erik. So,
yeah. Pick one for me to address.
Yeah. So let's just talk about let's just talk about what does the labor market recovery function look like. That's something that a lot of people aren't focused on. There's just this assumption, as you mentioned, that the restaurants will open back up, hotels will open up, and capacity will be back where it was, or at least very close to where it was, let's say, in January of this year.
Well, let's start with the labor market. I mean, it's definitely not sort of the same across the labor market. If you look currently at people who lost their job, they tend to be younger people, they tend to be minorities, and they tend to be women. And the groups that actually represent all those three are actually the ones that are hurt most. So we definitely see that the immediate effects of these inequalities are quite large. Now, the question is how quickly can come people back. I mean, a lot of these people are working in restaurants on low wages. Once these restaurants are open up, they will probably be hired to some extent, not all of them, but some of them. So it's a little hard to say what the longer term inequality effects of those are, but in the short term, there are huge inequality effects that are actually exacerbated by this crisis.
Right, and that's what I'm thinking about too. When if you look at the source of the economy, we always hear that it's significantly driven by the consumer, and one of those key attributes is the ability to earn income. And so we know that there's a lot of debt load out there, and that you can,
Right.
there's some of that consumption is based on debt, but you need to have the labor market recovery and wages to recover in order to really keep the economy going. So how given your comments there and this displacement, how does that impact the way you guys are thinking about the U.S. economy?
That's one of the points that Bart brought up earlier on. This is the whole second round sort of effects of this turning into a more classical recession, right? The initial shock of COVID was a supply side shock that impacted businesses, right? Manufacturers shut down, restaurants shut down, airlines shut down. And as a function of that, we've seen the spike in initial unemployment claims. We've seen the spike in the official unemployment rate. And so the question then becomes, okay, so what point does this supply side shock become a more classical demand side recession? And that's an open question. we think about this. We try to watch data that are important in determining that. But certainly, the longer businesses stay shut, the longer the economy stays shut, the more of the income impact there is, the higher the probability that this is going to have second order impacts, and that this is going to turn into a longer term, more difficult to recover from kind of a recession.
So one thing that I'd like to add to that is actually going back to an earlier comment that you made on the recovery of the financial market, because we, of course, also have been puzzled about how can it be that the financial market is recovering so quickly and the economy is not. So I was interested in comparing that performance with some previous big crises. So I compared it with the global recession that we had in 2008-09, but also compared it with the depression of the 1930s. And actually, the comparison with the depression is very interesting, because what you see is that the decline that we've been seeing until March 23rd, as you mentioned, was actually pretty close to what we've been seeing after the collapse in October 2027. That was a similar period in which we saw this very rapid decline happening. Interestingly, we saw after a few months in 29, we saw also this kind of recovery taking place. And a lot of that recovery is like what it was today. It's kind of the FOMO thing, like fear of missing out. So, people are just expecting that things will be coming to get better. And that goes on for a while. But then in the 1930s, later in the early 1930s, you saw it come down again. And why did the market then start to come down again? Well, that was because, we got something at that time was called the Smoot-Hawley Act, which was really this act that was the beginning of increased tariffs and import duties and protectionism. So you can see that, at some point, the markets are going to adjust to the economic reality and the political reality that you're looking at.
Okay, yeah, no, I think that's a very interesting point too. And so, like when you think about the financial markets, it seems to me you mentioned FOMO, which a lot of us have referenced in describing what's going on. People were taught in the post-financial crisis that you buy the dip, and another thing out there besides buying the dip was in Fed we trust, right? And so that mantra of that the Fed will have your back in times of crisis and when markets collapse. I think it's only been amplified in this one. And again, yeah. I'm not here to criticize the Fed for stepping in at this point. We can talk about the policies, how effective they'll be, but they're definitely trying to do something versus just sitting on their hands. So I think they need to be commended for that. But when you think about liquidity, and you think about what the Fed facilities have done and these various programs have done, they're really trying to create they're relieving the financial markets of liquidity stress. But that doesn't solve the underlying crisis of solvency. It doesn't solve the problem of bad businesses. And so, how do is there any way you can model the kind of Fed liquidity into these types of forecasts? Like when you're talking about the overall economy?
Bart, you've talked a little bit about the potential productivity, changes that may result from this. Maybe you can touch on that a little bit.
Yeah, absolutely. I think one of the things that you really have now to begin to think about once you come out of this crisis is begin to think, what is going to be the driver of recovery? Is that going to be, increased investment, increased hiring? Or is it actually going to be increased things like productivity and more efficiency? Usually what you see, no crisis goes unwasted. So what you quite often see in a crisis is that, some companies will go bankrupt. At the moment, they go bankrupt because of liquidity issues. But later on in the recession, they will go bankrupt simply because they aren't fit to actually deal with a long crisis and then be able to recover. So when you come out of a crisis, you get a recovery in terms of productivity growth, which, by the way, we badly needed because productivity had been declining for such a long time before we hit into this recession. The question, however, if that recovery is going to be quick enough, rapid enough to offset the fact, that companies are reluctant to invest and to rehire. So you've got multiple factors that are going to impact on this recovery. And, it's been good that we had a lot of digital transformation happening before we got into this crisis, but it hasn't really fully translated into productivity. So maybe the fact that we're now all teleworking and doing all these calls on video and so on is going to be an acceleration of that kind of digital transformation and productivity growth. But that, of course, still remains to be seen.
Right. No, and then people were always speculating, well, is productivity measured the same in this more digital world? And are we using the same type, are we using kind of stale inputs and thinking about productivity? But I think the same thing on kind of velocity here, the velocity of money. And so what we've seen is a massive growth in M2 in the crisis. And really, as of late, there's been a huge increase in M2. But unless we get velocity, which has been declining for 2 decades, and maybe the late 90s were the aberration, and we should think about velocity differently. But how do you think about that when, going back to the basic kind of GDP equation, thinking about money supply and velocity? How do you think that gets impacted by this kind of post-COVID world?
Well, I mean, I'll take a stab at that. With an increase in M2, as the Fed is more active in ensuring liquidity in various markets. Bart mentioned earlier on that we're seeing savings rates rise again and again. On Friday, we'll get some new data out there. So, as businesses are more reluctant to invest, as consumers are more reluctant to spend, you can pump money in, but unless you sort of loosen the tap a little bit and allow it to flow more rapidly vis-a-vis velocity, you're not going to really see that drum up overall economic growth vis-a-vis GDP expanding more rapidly. You got to
you just can't create aggregate demand, right?
It's the M2 and the V2 that are critical here.
Yeah.
Right, and that's one part of the story. The other part of the story goes back to this productivity issue, and that is, where does all that liquidity, where does all that money go? And what we have seen, the reason why I mentioned that we've seen this big productivity decline or slowdown happening before the crisis is because a lot of that liquidity got allocated to places where you didn't necessarily, get a bit of a bang for your buck, right? I mean, if the stuff is for free, it just gets wasted. And I think the more we add to it, that's to the earlier point that you made. I mean, it's great that the Fed is stepping in right now, but that's what you need. You need a floor at this point in time. The question is, what is it going to do in the longer term? And we know that in the longer term, this is creating misallocations. It's relating to inefficiencies and so on, and that makes the productivity recovery so much more difficult.
Right. Well, you mentioned that too, and you talk about that when you say misallocation. I assume you're talking about misallocation of capital and resources. But
Correct.
Can we ever go to a post-Fed world? Because you mentioned that too, and I think it's so critical here. We're talking about, perhaps there's misallocation of capital and just throwing money at things. But how do we ever get out of this? We saw when the Federal Reserve, when Bernanke did QE originally back in the crisis, back in 08 and 09, what he said is that it's temporary. We'll get out of it shortly. It took him 8 years to actually start to try to unwind the balance sheet. Didn't really work that well. They did it for about 18 months or so, got it down, about 800 billion or so. And then we had this problem. And here we've increased the balance sheet by, over $3 trillion from that level. And so the question is that, are we kind of caught in this, this kind of, I won't call it a liquidity trap, but a Fed trap where we have to keep printing money just to keep the system going?
Well, it's true that it is, it's 11 years since we hit in this current recession that we're in, and it's only in the last 3-4 years before the recession that the Fed started to unwind the balance sheet again. So it's true that it has taken a long time before we actually could hit that turning point. And I think that experiment, which now is bigger actually than it was in 2008 or 2009, will be repeated again, is how long does it take to actually begin unwinding? And I think that is going to be a critical question. Can we this time unwind faster, or are we getting so addicted to all that kind of additional liquidity that we're really in reality moving into what we call modern monetary financing? I mean, I'm amazed about the fact that 4 months ago MMT was an extraordinary left-wing idea that wasn't really much appealing to the establishment. And today, I would say we're pretty close to what I think MMT is actually be about, particularly if we keep this going for much longer.
Yeah, well, there's another discussion about extending some of these benefits out in the House today, and trying to get more of these programs out there. And you can see typically in these bills too that it definitely reeks of the MMT idea in there. And I think Sam, maybe it was you that joked about it, but someone said, well, effectively COVID, man, that Bernie won. That his kind of left-wing policies got through the economy. But one thing you had mentioned is kind of how we were dealing with the world pre-COVID, and you talked about supply chains. And so as I think about that, Erik, I know you're the conference board expert on China. Maybe you could talk about, what we were doing with China with the trade wars. We've seen re-escalation as of late again, the Hong Kong issues brewing. Maybe you can give us some of your thoughts on what's going on in the Chinese mainland today.
Yeah, sure. I mean, it's really a fascinating story with lots of twists and turns. But I mean, really, I think to understand where we are now, you have to go back, maybe about 4 years or so, or really around the election of the current administration. The trend towards a more confrontational relationship between China and the U.S. had been growing well before that point in time. But certainly the way in which the U.S. and China has sort of interfaced over the last 3 years is very much a function possibly of the communication style of the president. We saw, his first year in office, for the most part, the U.S. was able to sort of confront NAFTA, renegotiate that. There was a lot of animosity towards Europe on trade, but there wasn't a lot of movement actually on China itself until the second year. That's when the tariffs started to fly up. That's when things really started to get more aggressive. And so this really kind of played out over the course of late 2018 and throughout 2019. With a series of negotiations going back and forth, things improving, things falling apart once again, until January of this year, when we had a phase one trade agreement signed between the two parties. Now, the phase one really kind of picked the low-hanging fruit in terms of disagreements between the U.S. and China in terms of the degree of the trade imbalance and maybe certain market access issues. But there were a lot of other issues with respect to intellectual property, which with respect to the way that China manages its economy that were not addressed. And those were going to be addressed in sort of the phase two deal. And then we had COVID hit. And COVID kind of threw all those chips up into the air again. So at present, we have a situation in which Beijing is still saying that it wants to fulfill the terms that it agreed to under the phase one deal. The U.S. is shaking the tree with respect to things like China's access to U.S. capital markets vis-a-vis this delisting story that I'm sure that you've been reading about. And then all of a sudden we have the new security law being introduced at the National People's Congress in China, which significantly sort of deteriorates the sort of freedoms of people in Hong Kong, which the U.S. is threatening to do unroll sanctions and start to treat Hong Kong as a non-autonomous entity. So, the situation has gotten much worse in recent months. I'm not terribly pessimistic that phase one is going to fall apart, but I really do not think that there is any room for a phase two trade deal to be had before the end of this year. I'm not actually very optimistic that it can ever be had. And the Hong Kong issue, we're going to have to watch and wait and see what happens there. But certainly, on so many different dimensions, the relationship between Beijing and Washington has really spun out of control over the last 2 to 3 months.
Yeah. Well, no, I think, and that's the big wild card here is, are these trade escalations at this point, are they just, being political chips as the administration seems to have used in the past, or, do they have more teeth to that? So I think we'll all have to stay tuned to figure out,
And that, by the way, was just the point that I was making, comparing this with the 1930s, right? Because if you think about the timing of, trade disputes, that timing is actually surprisingly close to what it was in early 1930, if you get that thing popping up again. The other thing I may want to quickly add here is I'm really, the implication of this for supply chains, as you mentioned, could be quite substantial. I mean, there's all this pressure now for what I call domestifying supply chains, so bringing supply chains back to within our borders. And you don't only hear that in the US, you also hear this in European countries. And I think it's frightening, because let's not forget that we started offshoring because there were huge efficiency gains largely passed on to the consumers. If we bring this back, we hear all companies saying, first of all, it will take a long time before we can do that, and it will be incredibly expensive. So, the question is, who's going to pay for that? And if you think about one force that could potentially push up inflation, I think it could potentially be the domestifying of supply chains.
Right. No, that's definitely it. And, as you mentioned, you said it's you never let a good crisis go to waste. And I think, that could be kind of the post-COVID world. We could see a resurgence in U.S.-based manufacturing and the likes, which, as you mentioned, could lead to inflation through definitely increased wages when it comes to the labor input side of the equation. But, guys, I really appreciate this. It's been great. I think all our listeners can understand why we wanted to have you in a tandem. You guys are both good on a standalone basis, but it's like any good group out there. And so using some of my rap background, I think, Dr. Dre and Snoop Dogg were better together. Eric B and Rakim were much better together, and definitely Method Man and Redman. That neither of them can stand alone. They'd come together so great. And so, with that, I want to give you guys kudos. We thank you for having you on. Keep putting out the great work you guys do. For those listeners out there, before we go to Sam's favorite part of the show, is there a way that they can follow your work, either in some sort of social media or some websites?
Well, there's always Twitter, and just go Twitter the conference board, and you'll get to us, our own tweets, and just go to the conference board website. We have actually a dedicated website where every day there's new content on COVID-19, conferenceboard.org. That's a place to find everything that we have.
Okay, well, thanks for that. But before we let you go, Sam has a favorite part of the show. It's not just the economic recap. It's called Sherman Says. And Sam, why don't you kick us off?
All right, that favorite part is Sherman Says, as you mentioned. And the rules of the road here, gentlemen, are that I will offer a series of prompts. I'll begin with Jeff Sherman and then move to Bart and then to you, Erik, and then we'll rotate, rinse and repeat on that. And what I'd like from each of you is a short, top-of-mind response to my prompts. And if you want to be incredibly concise, you can limit that to one word even. That's the challenge. So I'm going to start out with Mr. Sherman with consumer confidence.
Bottoming.
Bart, existing home sales.
Glimmer of hope.
Erik, Hong Kong.
A potential catalyst for a downward spiral.
Sherman with summer vacation.
Vacation from home.
GDP.
Unprecedented decline.
Infrastructure.
We'll take it if you'll give it.
Social gatherings.
Memories.
Austerity.
Not again.
Urban flight.
Welcome to the suburbs.
Home offices.
Challenging.
Work offices.
What is that?
I remember when we used to do that.
And the final one goes out to Erik with U3 unemployment rate.
Bottom.
All right, there you have it. So once again, thanks guys for joining. For those of you still hanging in there on the Sherman Show here, we've had Bart Van Ark as well as Erik Lundh, both from the conference board. They've been great. They put out a great amount of information on their website. Follow them on Twitter. They put out great charts, good stuff to really help you understand and think about kind of the inputs and trying to reconcile, what's going on in this crazy, crazy world today. So Bart, Erik, thank you so much for joining us in this Safer from Home episode of the Sherman Show.
Thanks for having us.
You're welcome.
Thank you for joining this episode of Indications. If you like this content, please subscribe to the series and other content at the Conference Board at conference-board.org/podcast, or, of course, at your own favorite podcast platform. I'm Bart van Ark, Chief Economist at the Conference Board.
This has been Indications from the Conference Board.